the architect of modern portfolios, the life, philosophy, and timeless lessons of David Swensen. Good morning. It is a privilege to be with you all once again as we continue our journey through the minds that have shaped the world of investing. We have studied the titans of speculation, the pioneers of global value, and the monarchs of the bond market. Today, we turn our attention to a figure whose influence, while perhaps less visible to the public, has fundamentally reshaped the very architecture of institutional wealth, and whose principles offer a powerful, sober blueprint for any serious investor. He was not a speculator or a stock picker in the traditional sense. He was a master architect of portfolios, a revolutionary in the science of asset allocation. His canvas was not a single stock or bond, but the entire universe of investable assets, and his masterpiece was the endowment of Yale University. His name was David Swensen. For over 3 decades, he served as the chief investment officer of Yale University, and in that time, he did nothing less than invent a new way to manage money. He pioneered what is now known as the Yale model, a framework that shattered conventional wisdom and generated returns so consistent and so superior that it became the envy of the financial world. His story is not one of flashy trades or market timing calls, but of intellectual rigor, long-term vision, and a profound understanding of the mathematical and philosophical underpinnings of diversification. His career offers a masterclass in strategic thinking, discipline, and the quiet power of conviction. Act 1. The academic roots. From professor to portfolio manager to understand David Swensen, one must first appreciate that he was, at his core, an academic. He was not a product of Wall Street. He was a product of the University of Wisconsin-River Falls and Yale University, where he earned his PhD in economics. His doctoral dissertation was on the corporate finance theory of valuation for complex securities, a topic that required a deep understanding of mathematical modeling and the time value of money. This academic grounding provided him with a rigorous analytical framework that would later distinguish him from the often intuitive approaches of his peers. After completing his doctorate, he went to work on Wall Street for a brief period at Salomon Brothers and then Lehman Brothers, where he developed new financial technologies, including the first currency swap. It was here that he witnessed the inner workings of high finance. But the culture of Wall Street, with its focus on short-term profits and transactional relationships, did not sit well with him. He was a long-term thinker, an intellectual, and he found the prevailing ethos to be at odds with his own values. In 1985, at the age of 31, he received a call that would change his life and the future of institutional investing. Yale University, his alma mater, asked him to return to New Haven to take over the management of its endowment, which at the time was worth about $1 billion. It was a fraction of the size of the portfolios managed by his Wall Street counterparts, but for Swensen, it was a calling. He saw it not as a job, but as a mission to serve an institution he believed in. This sense of purpose, this alignment with a noble cause, would become a critical, often overlooked element of his success. When he arrived at Yale, he found an endowment managed in a thoroughly conventional manner. The portfolio was predominantly invested in U.S. stocks and bonds, with a small allocation to cash. It was, for all intents and purposes, a closet index fund. The investment approach was passive, and the results were mediocre. Swensen, looking through his academic and analytical lens, saw a profound inefficiency. He saw a portfolio that was poorly diversified, overexposed to the volatility of the public markets, and blind to a world of opportunity in less trafficked asset classes. Act 2. The invention of the Yale model, a new blueprint for diversification. David Swensen's revolution began with a simple, powerful question. What is the most efficient way to structure a portfolio to achieve superior long-term returns with an acceptable level of risk? His answer, which would evolve into the Yale model, was built on a foundation of first principles drawn from financial economic theory. particularly the work of Nobel laureates James Tobin and Harry Markowitz. Let us delve into the core, revolutionary tenets of his philosophy. First, the primacy of equity. Swensen believed that equities, as ownership claims on the productive capacity of corporations, provide the highest long-term returns of any major asset class. For an endowment with an infinite time horizon, the volatility of equities was a price worth paying for their superior growth potential. Therefore, the Yale model would be overwhelmingly equity-oriented. However, his definition of equity was far broader than just publicly traded stocks. Second, the power of diversification. This was his central, groundbreaking insight. Swensen looked at the traditional 60-40 stock bond portfolio and saw a mirage of diversification. He argued that in times of market stress, U.S. stocks and bonds often became correlated, failing to provide the promised buffer. True diversification, he argued, comes from owning assets that respond to different economic drivers. He sought what he called equity-like returns with low correlation to the public markets. This led him to a massive reallocation away from traditional U.S. stocks and bonds and into what were then considered alternative or non-traditional asset classes. He built the Yale portfolio around 6 core components: absolute return strategies, investments like hedge funds that aim to generate positive returns regardless of the direction of the stock or bond markets. These were market-neutral bets on manager skill. Private equity, investments in companies not listed on public exchanges. Swensen believed that by investing in private companies, Yale could capture an illiquidity premium, extra return for locking up capital for long periods, free from the short-term pressures of the public market. Real assets. Investments in tangible real-world things, like real estate, timberland, and oil and gas. These assets provided a hedge against unexpected inflation, which erodes the value of traditional financial assets. Foreign equity, investments in both developed and emerging markets outside the United States, providing geographic diversification. Domestic equity, a core, but now much smaller, holding of U.S. stocks. Fixed income, a minimal allocation to bonds, primarily for stability and as dry powder for future opportunities. This allocation was radical. In the 1980s and 90s, investing in private equity or timberland was considered exotic and highly risky. But Swensen, with his long-term horizon and academic conviction, saw these not as risks to be avoided, but as sources of return that were systematically underpriced by the market due to their complexity and illiquidity. Third, the disciplined implementation. Building this portfolio was only half the battle. The other half was managing it. Swensen's process was methodical and disciplined. He and his team would set long-term policy targets for each asset class. They would then engage in tactical rebalancing, meaning if one asset class performed exceptionally well and grew beyond its target allocation, they would systematically sell a portion of it and reinvest the proceeds into the underperforming asset classes. This forced them to buy low and sell high, in a disciplined, unemotional manner. It was the antithesis of chasing performance. Fourth, the focus on manager selection. Swensen believed that in the inefficient markets of private equity and absolute return, superior manager selection was the key to alpha. He and his team became renowned for their rigorous, qualitative due diligence. They sought out partners who were not just smart, but who had integrity, a strong alignment of interest, meaning they invested their own capital alongside Yale's, and a unique, repeatable investment process. They built deep, long-term relationships with a curated group of the world's best investment firms. This focus on people and partnership was something he felt Wall Street had forgotten. The results of this new model were nothing short of extraordinary. Under Swensen's stewardship, the Yale endowment grew from $1 billion to over $31 billion. It generated an annualized return of nearly 13% over 3 decades, significantly outperforming both the average university endowment and the broader U.S. stock market, and with lower volatility. The Yale model, was emulated by hundreds of endowments, foundations, and pensions around the world, forever changing how large pools of capital are managed. Act 3, the philosopher for the people, translating the Yale model for the individual investor. David Swensen's success at Yale was so profound that it created a paradox. He was a revolutionary for institutions. But what about the individual investor? Could the Yale model be applied to a personal portfolio? Swensen addressed this directly in his brilliant and accessible book, Unconventional Success, A Fundamental Approach to Personal Investment. In it, he performed a great public service by translating his sophisticated philosophy into a set of blunt, powerful principles for the Main Street investor. His message was starkly critical of much of the financial services industry. He argued that the industry, with its high fees, conflicted incentives, and product-pushing sales culture, was structurally designed to transfer wealth from investors to itself. His counsel for individuals was built on the same pillars as his Yale strategy, but adapted for a different context. First, he advocated for a similar, if simplified, asset allocation. He recommended that individuals, like Yale, create a diversified, equity-oriented portfolio. His sample portfolio for individuals included domestic stocks, foreign developed market stocks, emerging market stocks, real estate investment trusts, REITs, U.S., Treasury bonds, and Treasury inflation, protected securities. Tips. Notice the absence of corporate bonds. He believed the extra yield did not compensate for the risk, and that U.S. government bonds were the only true safe haven. Second, and most importantly, he was a zealot on the topic of low costs. He saw investment costs, management fees, trading commissions, and expense ratios as a deadweight drag on returns. For individuals, his prescription was simple and powerful. The best vehicle for achieving a low-cost, diversified portfolio is the index fund. He was a staunch advocate for passive investing for the vast majority of individuals, viewing it as the only way to ensure that market returns ended up in the pockets of the investor, not the financial intermediary. Third, he emphasized the critical importance of rebalancing. Just as he did at Yale, he advised individual investors to set a target allocation and then had the discipline to periodically sell assets that had appreciated and buy those that had depreciated, thereby maintaining their risk profile and enforcing a buy low, sell high discipline. The timeless lessons for the modern investor. The legacy of David Swensen provides a clear-eyed, principled framework for any investor, from the largest institution to the individual saving for retirement. 1. Structure determines outcome. Swensen's greatest lesson is that long-term investment success is determined more by the structure of your portfolio, your asset allocation, than by the individual securities you pick. Spending time to design a diversified, thoughtful portfolio based on your time horizon and risk tolerance is the single most important step you can take. Stock picking and market timing are, for most, a distraction from this fundamental task. 2. True diversification is hard. Diversification is not simply owning different stocks. It is about owning assets that zig when others zag. This means venturing beyond the familiar confines of the S&P 500 and considering asset classes like international stocks, real assets, and even, for those with the means and expertise, private investments. For the individual, this can be achieved through low-cost ETFs and mutual funds that provide exposure to these broader markets. 3. Costs are a cancer on performance. This is perhaps his most urgent message for the individual investor. Every dollar paid in fees is a dollar that cannot compound for you over time. The relentless pursuit of low-cost investment vehicles, primarily through index funds and ETFs, is one of the few guaranteed ways to improve your net returns. Be fiercely aware of the expense ratios of your funds and the fees charged by your advisors. 4. Discipline trumps emotion. The Yale model's success was built on a systematic process of rebalancing. This process forces you to act counter to your emotions, to sell your winners, which feels like selling your children, and to buy your losers, which feels like catching a falling knife. Having a written investment policy and the discipline to follow it is your best defense against the destructive impulses of greed and fear. 5. Align with honest, capable partners. Whether you are Yale selecting a private equity firm or an individual selecting a financial advisor, the principle is the same. Work with people of integrity whose interests are aligned with yours. Beware of salespeople disguised as advisors. Look for fee-only fiduciaries who are legally obligated to put your interests first. David Swensen passed away in 2021, but his intellectual legacy is immortal. He was a rare figure, a revolutionary who worked within the halls of academia, a man who mastered high finance but championed the cause of the everyday investor, a thinker who combined mathematical precision with a deep-seated ethical compass. He demonstrated that the most sophisticated investment strategy is often built on a foundation of simple, timeless principles. Diversify aggressively, control what you can, like costs and taxes, maintain a long-term perspective, and have the unwavering discipline to stick to your plan. In a world of financial noise and complexity, the quiet, rational voice of David Swensen remains a beacon of clarity and wisdom, reminding us that successful investing is not about being clever, but about being smart, structured, and steadfast. Thank you.